Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice raw sugar in New York. The key feature here in recent weeks has been the late April to date descending wedge pattern. That's currently 23.59 to 24.70, highlighted in dark blue on my daily chart. This morphed from an original sideways triangle into a descending wedge pattern 5 weeks ago. 3 weeks ago, the market broke out over the upper trend line. However, the move up soon got caught within congestion from early May and from the March 2012 high at 26.20. This halted the rise and pushed prices lower, back within the descending wedge pattern last week, such that the move higher can be regarded, as I said last week, as a false break higher. On the way down, the market broke through a number of key supports. These were the short medium moving average, currently at 25.26, the core of the recent support for the break higher, which is the 38.2% absolute Fibonacci line at 24.88, the July 2012 high at 24 even, and the nearby recent 50% Fibonacci line at 23.88, the rising medium moving average currently 23.61, the interesting neckline currently 22.81, which is highlighted in bright red on my daily chart, and finally the lesser Fibonacci and February 23 high at 22.35, though there was only a breach of this last combination as the market chose not to follow on further down to test the rising long moving average, currently 21.51, which is coincident with the November 2017 high at 21.48. Just below these is also the strong looking 50% Fibonacci line of the March 2021 to April 23 move at 21.04. So where does this leave us now? Well, 2 weeks ago we had a confirmed break above and out of the descending wedge pattern, and this week, well, we now seem to have a confirmed break back below it. This now should retire the upside targets for the descending wedge pattern, namely a primary target in the 27 even area and a secondary target X1 in the 28 even area, and set the up targets below for the descending wedge pattern. And I will lay out those targets below shortly. But I will also caution you on one thing. Descending wedge patterns breaking out on the downside have been known to create a dip, a drop in prices that looks like another false break on the downside before they resume a move higher towards their original topside targets. That being said, a primary target below, and I said I would leave those, was in the 2280 zone. A target's already been achieved. With a secondary harder to reach target X2 down in the 20.25 zone. This leaves us with just the big picture items, and here we have an interesting pair of potential pattern ideas. The first idea is one I previously put out, and that is to look at the action since mid-March as a possible bullish halfway hesitation. Well, this idea is now dead, and I will retire it. The contrary idea to this is that we have formed a double top. However, we have not seen prices even approach the April high at 27.42, and so such an idea does not really hold merit either, not yet at least, though I will reserve my judgment on this for at least another week. So for the moment I'll keep an open mind to see what will become the next big long-term pattern here. Ice Europe white sugar in London. I've been discussing here at length some of the big patterns seen. My first idea was to look at the action since April as a possible 3 peaks and domed house pattern. This pattern is a rare but large pattern. As a consequence, though I see elements of it here, I was not happy about this being a true pattern, and I thought about leaving it just there, just at that, at least until I see further evidence. However, last week I studied the action more closely and I realized that the action itself was a mirror to what I originally supposed. In other words, it was closer to a domed house and then the 3 peaks, not the 3 peaks first. Even now, it's still not a great example of such a pattern, but I will continue to see how this idea works or doesn't. The second pattern I looked at, and one I suspected had a greater chance and opportunity, was the idea of the action being a rounded top. This has worked itself through, There's been a messy second part of the pattern, primarily due to another new, smaller pattern that has emerged, which gave it an added kick on the downside. It is the late May to late June small bearish half hesitation, almost a bear flag pattern. Now this has already reached its target below in the 660 area, near the July 2012 high at 663.70, and exceeded it in fact. This extension lower punched down through the rising medium moving average, currently at 647 even, the 50% Fibonacci line, the influential and recent 50% of the January to April move at 628.80, the September 2016 high at 619.10, and finally was halted by the previously mentioned highly influential neckline, the August to December 2021 complex head and shoulders top, and that's currently at 614.40, which is highlighted in bright red on my daily chart. Interestingly, this was not the only support that held up prices, as though penetrated, the previously mentioned 50% Fibonacci line at 625.30 managed to keep prices in its vicinity on a closing basis. All this action has possibly revealed yet another pattern, one that may usurp the possible domed house and three peaks. I spoke about it last week, and it is to look at the whole mid-March to date action as a possible double top Eve and Adam type. Thus, for such a pattern, we've already achieved the primary target in a 630 area, but we still have a harder secondary target X in the 601 area below. This is significant as it is below the important neckline, though still above the flatlining long moving average, currently at 595.40. Whether this downside target is achievable will depend on how much of a retracement we have up and away from the neckline. Sugar white premium spread. We're over halfway into 2023, and this chart is still one of the busiest charts I have, and also one of the most colourful. Many things are going on all at the same time. Okay, so I had previously spoken about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021 highlighted in dark blue on my weekly chart. The market at the moment in between the lower time below, currently at 103 3/4, and the middle time above, currently at 178 even. I have said this so many times before, and I'll repeat again, this pitchfork, despite being breached in the past, still continues to show the overall major bullish angle of attack of this market. Next, we have an ascending expanding wedge pattern highlighted in bright red trend lines and above the current market. This was formed between mid-April to late November last year. That's currently 188 1/4 to right off the top of my weekly chart. To me, it was and still is not the best looking of such wedge patterns, but it is also still out there, despite being tested as recently as mid-April this year. And it comes with all the possibilities such a pattern invokes. The most recent activity had been the market's activity around and through all the moving averages, notably the long moving average, currently 130 1/4, and the medium moving average, currently 127 even. We have seen this activity push down through the two 50% Fibonacci lines at 128 3/4 and 131 1/2, and the June 2020 high at 134 even, much as if they weren't even there. Though the 50% Fibonacci lines are doing a reasonable job so far of capping the market. 3 weeks ago, I drew both a bullish Andrews and a bullish shift pitchfork for the August 2021 to February 2023 action. And I've once again not highlighted either of them, as they neither add nor subtract from the current picture. Though the lower time of the bullish shift pitchfork, currently at 120 1/4, is showing promise as a potential support. Now, I'm still open to drawing a further bearish pitchfork of some form to muddy the waters even further for the mid-September 2022 to mid-April 2023 action, but I'll see how prices treat the bullish pitchforks first. Now, the final point is a big picture item I had mentioned 3 weeks ago, and is to look at the whole 2022 to date action as a possible huge lopsided diamond top. 3 weeks ago, I just lodged that idea in my own mind and in yours, as there are elements of such a pattern here, but there seem to be enough going on elsewhere that I didn't wish to unnecessarily add to the mess of lines we already have. However, 2 weeks ago I decided to go ahead and draw this potential diamond top here, which you can see highlighted in dark green. As you can see, the prices have broken out of the bottom of this pattern, and though not dramatic, they have managed to stay below and outside the diamond pattern, long enough for me to set up some potential targets below. Thus the primary target X would be in the 47.5 zone, whilst the secondary harder, much harder to reach target X1, well, that would be down below zero, and for the moment I'll set aside such a negative target. Even the primary one, well, that would be a huge move, huge. So I'll just leave it at that for the moment. My final point is this: just be aware of false breaks. We really haven't moved that far down in the time given to not still see and keep a keen eye for all this to be a possible false break lower. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.